Understanding wealth management structures and corporate tax treatment of family foundations. There are various legal structures that individuals and families can establish to manage personal wealth, investments, and achieve specific objectives, such as asset protection, succession planning, philanthropy, or wealth consolidation. Among these structures are contractual trusts, private trust companies, and foundations, each designed to hold and manage assets on behalf of individuals or their families, offering both protection and long-term benefits. While these structures have unique legal and operational characteristics, they also vary in how they are treated for corporate tax purposes. The taxation of such entities depends on their legal classification and purpose, with specific provisions for those managing private wealth as family foundations. 1. Common structures for personal wealth management. In wealth management, entities are often established to offer benefits such as asset protection, ease of transfer across generations, and philanthropic support. These entities might include contractual trusts. Typically agreements where a trustee is tasked with managing assets for beneficiaries according to the terms of the trust deed. Private trust companies. Often formed specifically to serve as a trustee for a family trust or a series of family trusts, maintaining close control over family assets. Foundations. Independent legal entities that hold assets for specific purposes, often including wealth preservation, family support, or charitable aims. Notably, foundations in the Abu Dhabi Global Market, ADGM, and the Dubai International Financial Center, DIFC, are granted separate legal personality. 2. Corporate tax treatment of wealth management entities. For corporate tax purposes, entities such as trusts and foundations are treated differently depending on their legal personality and operational scope. Fiscally transparent entities. Many of these wealth management structures, especially trusts, are by default considered fiscally transparent. This means the income and assets are seen as directly owned or earned by the individual beneficiaries rather than the entity itself. Such entities do not typically fall within the scope of corporate tax, as they are considered an extension of the individual's ownership. Entities with separate legal personality. Some entities, including foundations established in ADGM and DIFC, are treated as independent juridical persons with their own legal personality. These entities are classified as corporate taxable persons, and thus their income is subject to corporate tax. This classification aligns their tax treatment with that of other corporate bodies operating within the UAE. 3. Taxation challenges for family foundations. When entities like foundations serve primarily to hold and manage personal wealth and assets on behalf of natural persons, rather than for commercial activities, they create a unique situation. Even though they operate similarly to personal ownership, their treatment as taxable persons could result in a corporate tax treatment that is inconsistent with the tax outcome for individuals managing these assets directly. In essence, natural persons versus family foundations. If individuals were to hold and manage assets directly, the income might not be subject to corporate tax. However, if managed through a family foundation, the income would fall under corporate tax, leading to an incongruent tax burden based purely on the choice of management structure. 4. Tax transparency option for family foundations. To address this disparity, the UAE Federal Tax Authority, FTA, provides an option for family foundations to apply for treatment as an unincorporated partnership. This option allows the family foundation to achieve fiscal transparency by meeting certain conditions and receiving approval from the FTA. Here's how it works. Application process. Family foundations that qualify can apply to the FTA to be treated as an unincorporated partnership. Transparent tax status. If the application is approved, the family foundation will be regarded as tax transparent. This effectively means that beneficiaries will be treated as if they directly own or benefit from the foundation's assets and activities. In other words, the foundation itself will not be subject to corporate tax. Rather, tax obligations would shift to the beneficiaries directly. By treating the foundation as an unincorporated partnership, beneficiaries enjoy a more aligned tax outcome, preserving the benefits of managing assets through a foundation without incurring additional tax burdens. Effective date: if granted, the tax-transparent status for the family foundation can be retroactive or future-facing. The effective date for this treatment could be from the start of the tax period in which the application is made, from the start of a subsequent tax period, or from any other date specified by the FTA. This flexibility in timing allows family foundations to align the tax treatment with their strategic planning needs and provides clarity on tax obligations.